Over $1 trillion in transactions will be processed by smart contracts this year alone. And the vast majority of the companies still running on paper contracts, middlemen, and outdated legal frameworks have absolutely no idea what is about to hit them. Welcome to BlockVault Daily. I am about to show you exactly how smart contracts are quietly rewriting the rules of doing business, why some of the world's largest industries are scrambling to catch up, and what this technology actually means for everyday commerce at a level most people never think about. And here is the part that will genuinely surprise you: the biggest revolution smart contracts are causing has nothing to do with cryptocurrency at all. Stay with me, because by the end of this video, the way you think about agreements, trust, and commerce will never be the same. To understand smart contracts, you need to go back to 1994. A cryptographer named Nick Szabo had an idea that sounded almost too simple. What if a contract could execute itself? What if instead of relying on lawyers, courts, and enforcement mechanisms, the terms of an agreement were written directly into code, and that code automatically carried out every clause the moment conditions were met? Szabo called them smart contracts. But the technology of 1994 simply did not exist to make it real. The internet was barely functional. There was no blockchain. There was no decentralized infrastructure to host self-executing code in a trustworthy way. The idea sat on the shelf for nearly 2 decades. Then in 2015, Ethereum launched. Vitalik Buterin and his team built a blockchain specifically designed to run programmable code on top of it. For the first time in history, Szabo's vision had the infrastructure it needed. Developers could now write logic directly onto a decentralized network where no single party controlled the outcome. If condition A is met, then action B happens automatically. No human needed to press a button. No third party needed to verify anything. The contract simply ran. Early adoption was messy. The infamous DAO hack of 2016 exposed vulnerabilities in poorly written smart contract code and resulted in $60 million being drained from an Ethereum-based fund. Critics called the entire concept fatally flawed. But here is what nobody talks about: that attack did not break smart contracts. It exposed bad code. And just like early internet security failures did not kill the internet, early smart contract exploits accelerated better coding practices, auditing standards, and security infrastructure. By 2020, the total value locked inside smart contract protocols crossed $1 billion for the first time. By 2021, it had crossed $100 billion. That is a 100-fold increase in roughly 12 months. The technology was not just surviving. It was compounding at a rate that almost no industry had ever seen before. So what are smart contracts actually changing? Let us start with finance, because that is where the disruption has been most visible and most dramatic. Traditional finance relies on a complex web of intermediaries. When you wire money internationally, your bank talks to a correspondent bank, which talks to another correspondent bank, which talks to the recipient's bank. This process takes anywhere from 1 to 5 business days and costs an average of 6.2% in fees according to World Bank data. Smart contracts collapse this entire chain. A decentralized exchange powered by smart contracts can settle a transaction in under 30 seconds with fees measured in fractions of a cent. The intermediaries simply become unnecessary. Decentralized lending protocols like Aave and Compound are using smart contracts to allow people to borrow and lend money without a bank ever being involved. The smart contract holds the collateral, calculates the interest in real time, and automatically liquidates positions if collateral falls below required thresholds. In 2023, these protocols processed over $50 billion in loans. No loan officer. No credit check in the traditional sense. No branch office. Just code. But finance is just the beginning. Think about supply chain management. Right now, tracking a product from raw material to retail shelf involves dozens of handoffs, paper documents, and manual verification steps. Walmart discovered this the hard way when it took 6 days, 18 hours, and 26 minutes to trace a package of mangoes back to its farm of origin. 6 days. After partnering with IBM on a blockchain-based smart contract system, they reduced that trace time to 2.2 seconds. That is not an incremental improvement. That is a complete reimagining of how supply chain accountability works. Maersk, the world's largest shipping company, integrated smart contracts into its global logistics operations and reported savings of hundreds of millions of dollars annually by eliminating paperwork, reducing fraud, and automating customs clearance processes. When a shipment crosses a border, the smart contract can automatically verify documentation, release payment, and update inventory records simultaneously. What used to take days of coordination now happens in a single automated transaction. Here is a number that should stop you cold. The global trade finance gap, meaning the amount of legitimate trade that cannot get funded because of bureaucratic friction and documentation failures, currently stands at $1.7 trillion per year according to the Asian Development Bank. Smart contracts have the structural capacity to close a significant portion of that gap by making trade finance faster, cheaper, and more accessible to businesses in developing markets that traditional banking has always underserved. Real estate is another industry being fundamentally restructured. Property transactions are notorious for their inefficiency. The average home sale in the United States involves over 100 pages of documentation, takes 30 to 45 days to close, and costs buyers and sellers thousands of dollars in escrow fees, title insurance, and legal costs. Smart contracts can automate the escrow process entirely. The buyer deposits funds into a smart contract. The seller transfers the deed via a tokenized asset on the blockchain. When all conditions are met, the funds release automatically and the ownership record updates instantly on an immutable ledger. Companies like Propy have already completed fully blockchain-based real estate transactions in the United States and Europe. This is not theoretical. It is happening right now. Insurance is another sector where smart contracts are creating what industry analysts call parametric insurance. Traditional insurance requires a claim to be filed, investigated, evaluated, and approved, a process that can take weeks or months. Parametric insurance powered by smart contracts works differently. The contract is linked to real-world data feeds called oracles. If a farmer's region receives less than a predetermined amount of rainfall in a season, the smart contract detects that condition through the oracle, verifies it, and automatically releases payment to the farmer. No claim needed. No adjuster required. The policy simply executes. Etherisk and other platforms are already deploying this model in African agricultural markets where traditional insurance has historically been completely inaccessible. But here is what nobody talks about when it comes to smart contracts in business. The deepest transformation is not about speed or cost savings. It is about trust. Every traditional business relationship requires some mechanism for enforcing agreements. You trust the other party, or you hire lawyers to protect you if they break their word, or you work through regulated intermediaries who are legally accountable. All of that infrastructure exists because human beings and organizations cannot always be trusted to honor their commitments without external pressure. Smart contracts change the fundamental nature of that problem. When the terms are written in code and the execution is automatic and decentralized, you do not need to trust the counterparty. You trust the math. You trust the code. An audited, well-written code does not lie, does not forget, and does not get corrupted by self-interest. This is why enterprises like JP Morgan, HSBC, and Siemens are not dismissing smart contracts. They are actively building on them. JP Morgan's Onyx platform has processed over $900 billion in short-term loan transactions using blockchain infrastructure. These are not crypto enthusiasts. These are legacy institutions that have spent decades building trust-based systems and are now recognizing that code-based trust is more reliable, more scalable, and more efficient than anything they have built before. The trajectory here is unmistakable. Gartner estimates that smart contracts will touch over 25% of global business contracts by 2030. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Block Vault Daily for a brand new video every single day. We will see you in the next one.